Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Jeremy Kokemor, the founder of Right-Tail Capital. After several buy-side stints, including at T. Rowe Price, Jeremy founded Right-Tail in 2022. Jeremy runs a concentrated portfolio of high-quality companies that just happen to be trading at large discounts to intrinsic value. In this wide-ranging conversation, we discussed why he decided on the name Right-Tail, his definition of a quality company, what concentration means to Jeremy and how that translates to position sizing, the ways in which he has intentionally created alignment between himself and his investors, and stocks that have taught him lessons and served as mentors. And without any further ado, here's my conversation with Right-Tail Capital's Jeremy Kokemor. I'm interested in the name you chose, Right-Tail Capital. Can you talk about what that name symbolizes to you?
Sure. So Ben, when I was thinking about potentially, naming this investment firm, Right-Tail Capital was the one name that really jumped out to me and really resonated. And there were really four parts that kind of four types of meaning that the name kind of symbolized for me. First and foremost, I really want Right-Tail's after-tax returns to be incredible and to be great for our investors, or to be in the right tail. Secondly, I'm typically going to be investing in companies that are higher quality, and I would say have proven themselves to be in the right tail, both relative to their peers in their industry group and oftentimes to just companies at large. And then there were two personal reasons that the name Right-Tail really jumped out to me. First and foremost is I love the whole process of how do we all get a little bit better over time. And that knowledge and that experience can just compound the same way we want our wealth and our investment returns to do. And so whether it's investing, whether it's things like health, whether it's, kind of general reading and knowledge, I love that process of trying to get a little bit better each day and recognize what a big impact that can have over time. And then the last reason was just that, I didn't grow up with much. I grew up in New Orleans. I was the oldest of three kids, and my parents got divorced when I was 5 or 6. And I really felt the financial strains of our family over time, and always had, jobs when I was young, helping to teach math in middle school, and then doing the work study program in high school and financing my college education. And so I say these things just that the opportunity to help improve someone else's financial outcomes and to generate further wealth is just something that I take really seriously. So those were the four reasons why the name Right-Tail really appealed to me.
So we kind of went backwards. We started with the name, and now we're going to talk about the founding story. So you started the firm in 2022. Can you discuss the spark that led you to found Right and, go out on your own to try to build your own firm?
Sure. So it's been a long-term dream of mine, even going back to writing one of my business school essays in 2007 before I went to Harvard Business School, that one day I might want to start an investment firm. And in early 2022, there were just several stars that kind of aligned where it kind of seemed like now was a great time to try to fulfill this dream. First and foremost, we have 3 beautiful children. Thankfully they're all healthy. They're all doing well in school, and we've kind of been able to see, just that they were doing well in school. Secondly, my wife was interested in going back to work after doing a great job of kind of raising our family. Third, we had kind of saved up, enough money where we thought we could, appropriately invest alongside all of our other right-tail investors and really create great alignment, while also giving the business strong enough duration to really show what we could do on the investment side. So there are all these factors that kind of came together early last year. And then I would just add to that, I'm in my early 40s, and I felt like I had the right mix of energy. I love investing. I love learning. I want to do this hopefully for another 4 decades, and think that I'll be investing for as long as I can still think soundly. And then secondly, a great amount of experience as well to kind of share with other folks, and to share that energy and that passion and that experience. And so, anytime you make a big decision, potentially one like starting an investment firm, there's probably not for most of us will there be someone who kind of, knocks on your door with an answer key and a pot of gold and says, hey, you should do this right now. But those were the reasons why it really felt like the ideal time for me to found Right-Tail.
In that response, you mentioned alignment, and in your investor presentation, you talk about setting up a structure where you are aligned with your investors. Can you talk about the mechanisms you've employed to ensure that alignment?
Sure. So first is, one that we've already mentioned, which is our family has a significant alignment with all of Right-Tail investors. So we'll win together. When times are tougher, we'll suffer together. But I want everybody to know that I'm right there with you through it all. And to me, that's just the way that it should be. And so today, my wife and I are, will likely always be Right-Tail's largest investor in terms of percentage of net worth. Today, we also happen to be the largest investor in terms of dollars as well. Secondly, in terms of alignment, I, spent a lot of time thinking about what is kind of a fair and well-aligned fee structure. And I've always respected and been enamored by the fee structure from Warren Buffett's original partnerships in the 50s and 60s. And so one of Right-Tail's fee structures is a no management fee, all performance fee, which is 25% over a 6% hard hurdle. And so that was another way that I felt really created alignment, with all of our investors. I do also offer a management fee only structure, just to kind of provide folks with a choice. And I've been amazed just that a lot of us just have different preferences, and I want each investor to be happiest. And then, other ways that I create alignment, one, I've kept costs, appropriate, but I would also say low for the business side. And to me, that helps further create alignment, because I want each investor to know that I'm not worrying about, the P&L of the business. I'm focusing as much as possible on long-term excellent investment results. And so keeping costs low and sufficient is kind of one of the many things that I do to just kind of make sure that I'm in kind of the healthiest and kind of right mindset to encourage this type of long-term thinking that I think will ultimately lead to some great investment success for Rightail.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders.
Great. And so maybe we can jump in now to the investing side. I talked about the structure and the alignment and the founding story. So I generally hate to put people in style boxes because the growth and value labels miss a lot of nuance. But having said that, when people ask you to define your style, how would you describe it? Like, where do you place yourself in the whatever, when you're talking to a potential client or an allocator, like where do you put yourself in the traditional boxes?
Sure. And I agree with you, Ben. I'm not a big fan of the boxes either, because I think about, I think Buffett talked about this in some of his letters in the early 1990s about, just the importance of value and growth, and that understanding growth is paramount to assessing a company's value. And I would always, candidly just kind of struggle with those questions during, interviews years ago and things like that, because oftentimes I just, I kind of wanted to say, I'm not exactly sure, I don't know. But the simplest way I would describe it is to say that I want to buy high quality businesses at as reasonable of a price as possible. If I have to pick one over the other, I'm often going to lean towards quality. And the way I tend to think about quality is that I would love for companies to have a long reinvestment runway. And there are a lot of factors that kind of go into that of, okay, well, what gives this company a long reinvestment runway, and what advantages does this company have? And then secondly, to be able to invest at high incremental returns. So number one, long reinvestment runway. Two, we want that reinvestment to be done at as high of a rate of return as possible. And those companies, if you buy them at a reasonable price, can really create a lot of value for shareholders over time.
Something I've thought a lot about, is that incremental returns, and then also the runway associated with that. What do you think the markers are of a business that has that runway? Like, if you were to categorize a generic, or even use an example if you want, but some kind of like, I look at this situation and I can, to the best of my ability, forecast a pretty long period for reinvestment. What does that look like? What kind of factors contribute to that?
Sure. It may be different, on a case by case basis, but, I'll just share a few examples that come to mind. So one might be a company like O'Reilly Auto Parts, where, I would say part of their reinvestment has been continuing to open new stores and kind of slowly taking share from mom and pop competitors, among others. So that would be one way for a company that maybe has a retail component to it. Another example might be a home building company like NVR, where over time they have built higher market shares in local markets, but in the grand scheme of things, I would say still has a pretty low market share across the whole country. So if you kind of believe that the company will continue to take share from others in the markets that they're in, and potentially enter new markets and wisely grow those businesses over time, the way that they've always done. Again, because of that lower market share and the great processes and great business model they have in place, those are a couple things that give me comfort that there's a longer reinvestment runway there.
And, just to satisfy the compliance side of this, do you own both of those securities?
I do own both of those securities today.
Got it. Okay. And so interesting, you didn't mention like a rapidly increasing TAM, which I think is people mostly think about a reinvestment run rate. They think of a TAM that's expanding. I don't know how much the auto repair, auto parts world is expanding rapidly. It's more like a share gain. Both of those are kind of share gain experience, kind of examples. How does the importance of a market that's getting larger over time, how does that factor into the quality assessment in your mind?
Sure. Yeah, I would say both of those companies, in my opinion, do have a market that is expanding. Although I completely hear your point that the addressable markets may not be expanding as rapidly as other examples that you and I could think of. But yeah, I would absolutely love for a market to be getting bigger versus getting smaller. And if a company already has competitive advantages, then having a bit of a further industry tailwind should only help going forward.
And you talk about trying to buy these quality businesses when they trade at very undervalued prices. So are you looking to buy companies with short-term clouds hanging over them? Or are you focused more on companies that can simply compound faster than people are expecting?
Sure. I would say there are two ways I think about that. One is, I absolutely research a lot of businesses that do have a shorter term cloud hanging over them. A lot of times I, may decide to pass or may realize I need to continue to study the business over time. But that is one fruitful area. Another area, would be, I would maybe want to add a bit of nuance to the way you framed the question, which is just that oftentimes I might find a company where the reinvestment runway seems to be there, at least as judged by history. The incremental returns on capital, maybe over the last 10 or 15 years, has been really strong. And I think this company will continue to have a competitive advantage and whatnot. And so sometimes you can find these companies, and who knows, maybe in a typical year, they grow earnings at 10 to 15% per year. And maybe you can buy this company at a discount to the average company, in the S&P 500 or something like that. And so in those cases, I'm not necessarily taking the view that I think the company is going to grow a lot faster than maybe the market thinks. And so I'm typically not going to be, buying a company where maybe the market thinks it can grow at 30% per year. And I come out with a different view and I'm like, no, I think that 30 is actually 50. That's probably not something I'm going to do. But there will certainly be times where I might take a different view and say, gosh, I think this is a much better business and this company can grow in a much more capital light fashion or higher return fashion than what I think the market kind of appreciates today. And so that's kind of how I would frame that second part of your question. So either high quality companies with a near term issue, or B, companies that are just steadily doing really, really well, where maybe the market underappreciates just how good that company is or what makes it special.
When you say you study a lot of businesses, makes me think of creating an investment universe of quality companies. Is that something you've done? Have you narrowed the universe of companies down to like a couple hundred that you'd like to own, and you do work on them beforehand so that, when the market hands you opportunities to buy them, then you can, or is it not quite that formulaic?
I think of it a bit more like I'm constantly building the library of companies that I might invest in. And, so this year, for instance, there have been 5 or so industries that I've spent a lot of time studying. I haven't made a big kind of new investment position this year so far, but I feel like the work's been really good, and it's kind of broadened out that universe or that library, so that when the time does come, and it could either be related to valuation or the company's stock price, or maybe even a downturn in the market, then I'll be prepared and hopefully have that knowledge to be ready to act. It also could be, as I build a library, that I found over time that I may not understand, every nuance that makes the company special the first time I study it. And so that knowledge kind of compounds over time, each time as I study the business. And, one of the times I can think of when I was most active in the portfolio, going back before Rightail was founded, was kind of in that early COVID period where, as you remember, lots of great businesses were down, maybe 40 or 50%. And as long as you continue to believe that, the company had a good enough balance sheet to get to the other side and a good management team and really good processes, that was a time in particular where having that library and that past knowledge accumulated really presented us with an opportunity to, act quickly and make some really good investments at that time.
In your response, you mentioned valuation. I know from reviewing your presentation material that you compare potential IRRs across the portfolio. I'm also curious about valuation methods you use. Are you using discounted cash flows? Are you using multiples analysis? Like how are you calculating in some kind of intrinsic value that allows you to calculate an IRR?
Sure. So I do look at multiples. I do look at discounted cash flows as well. I also try to break down a company's IRR almost into, some very simple bond math. So I'll look at three different components. One will be the cash earnings yield of the business, so kind of the inverse of the company's multiple. And then for the growth component of that cash earning stream, I'll think about how fast could this company grow if it were not reinvesting at all? And so, a couple of interesting case studies to think about there might be a company that already has either a network built or, a certain set of advantages that they can raise price a little bit each year, or the market is growing and they're already kind of entrenched. So maybe a Visa MasterCard or a Moody's or something like that can grow parts of their business without even necessarily needing to reinvest. And then the second bucket would be what we spent some time talking about, is how much can the company reinvest in terms of growth, and at what rates of return can they reinvest? And so, let's say they could invest, $100 a year at a 20% return. That would suggest that they're creating $20 of value each year, and then capitalize that $20 at a certain number as a percentage of the company's overall market cap. Will give you a third number that you could add to think about A, the cash earnings yield, B, how fast is the company growing without reinvestment, and then C, how much value are they creating each year from reinvestment. So, maybe you'll get 5% bucket A, 5% bucket B, 5% bucket C, and add those up and be able to approximate, hey, this seems like, a 15% IRR or a 5-year double is a possibility here.
And would you use a DCF as kind of a sanity check on that as well, or multiples as a sanity check on those IRRs to make sure that, what would, like, kind of reverse engineering, what would the numbers have to look like for you to be able to actually hit that kind of IRR?
Sure. Yeah. So the way the multiples in the DCF, one way that they'll really come into play is that I'm probably not going to invest in a lot of businesses where the current multiple is extremely high. So let's say, in that bond math example, that first bucket was like 1% because the multiple was 100 times. But maybe we still felt like the company was creating a ton of value each year. Well, thinking through the current multiple or thinking through the DCF, I'm probably going to be very, very wary that the ability for us to make a great return at those multiples is really there. So that's one way that, I will use it as a sanity check. But typically, I want to find in most environments businesses that I think can double in, 5 years, if not faster. last year, during certain parts of the market turmoil, there were times where I felt like I was finding potential 3 or 4 year doubles, and obviously those are great when the numbers start to look even more attractive. And the other thing I'd add too is I typically want to hold businesses for at least several years at a time. And so I kind of go into it thinking, hey, I'm planning to be patient here, and I want to let these excellent companies continue to create value for all of Retail's investors. And one thing I've learned over time is for a new name to enter the portfolio, I really don't want it to be replacing the last name, or whether that's the 15th name or the 12th name or whatever. I don't want to have that sort of incremental thinking. I really want to be able to, make a case to you and to myself that, hey, I think this business can fit into at least the top half of the portfolio. And if I do that, I feel like it gives me a bit of a greater margin of safety, helps me focus my time and energy on the right types of opportunities that will pay off for our investors.
Yeah. So the hurdle rate's not replacing the last stock in the portfolio. It's like, this should be if I'm going to own anything, it should be a top 5 position kind of mentality.
Exactly. And that's just something that I found, helps me over time and has worked well for me. And earlier in my career, the times when I would maybe, make that sort of incremental replacement that we're describing, it might lead me to, selling a business whose stock had performed well, and maybe I got, too anchored to a price target or something like that. And then B, I also recognize that, sometimes when I'm doing work on a new name, it's fun work, and it's easy to get excited about a new position to the portfolio. And, I want to remove as much of that emotion as possible, and not necessarily feel like it's just replacing, or a little bit better than maybe something towards the bottom of the portfolio.
So we've talked a little bit about portfolio construction. Concentration is a topic that we've discussed on this podcast at length. I would love to understand what concentration means for you personally and how that's reflected in your portfolio construction.
Sure. So today, Retail owns around 15 names. My guess will be, when we're talking 10 years from now, that, most of that time period, Retail will have owned somewhere between 10 and 15 names or something like that. And to me, concentration is great because, it really allows for, when you do good work and make good investments, to really have those investments can have a punchy impact on the overall return of the portfolio. So that's number one. I think it's also great from, a time standpoint, and really focusing on the best ideas and doing the maintenance work on some of the best ideas, which for me, somewhere in that 10 to 15 range, tends to feel really appropriate. And then I also want to do that with as little risk as possible, which for me means, I spend a lot of time just making sure that we have a fair amount of diversification within the portfolio. So, you'll never see Retail have, 15 names in one industry or split between 2 industries or something like that. And part of that is just that, look, I know that not every investment is going to work out the way that I think it might on day one. And so having a bit of diversification, still in a concentrated portfolio makes a ton of sense.
And one of your previous responses, you mentioned patience. So you want to own something for several years. I'm interested in how you handle situations in which, you own something for a while and it's quote unquote not working, right? And so how do you balance that? Hey, I want to be patient. I have a long-term view. My thesis hasn't been validated, with like, something is not working. What do I do? Do you double down and do more research? How do you avoid having, like, something just languishing in the portfolio at the 15th position, as opposed to, trying to get it up and out? up or out, basically?
Sure. So each time that I make an investment, I really want to think through ways that the investment may not go well. And I find that, having a bit of candor, around some reasons why the position may not work out, can be really helpful later in the process, because like you said, there are always going to be some stocks that aren't doing well in the portfolio for whatever reason. So, doing a bit of a pre-mortem there, is very helpful oftentimes. But then when those moments arrive, I just try really hard to, think through, hey, is the stock not working, but the reasons why I made the investment still there? And maybe the company's performing well, but the multiple has gone down for some reason. In that case, I might be more likely to either add to the position or hold on. If through additional work and thinking and conversations, with folks in the industry and things like that, I then start to think that, hey, maybe something about the original thesis has broken. There, I'm often going to elect to move on from the position. And for me, and there are a lot of different ways to invest, obviously, but I've just found that the times when I am honest and can kind of say, what, the thesis is broken here, it's often better for me to move on and to concentrate my energy on the remaining portfolio and finding that next great idea, than to feel like, I need to prove the original thesis right on, that investment or whatever the case might be. So I try to just have very little ego around it, and to approach each, situation objectively, and to recognize that, these businesses, don't know whether Retail owns them or not. And there are always going to be a lot of opportunities out there.
I'm interested in how you settled on 10 to 15 stocks versus 5 to 10 or 20 to 25. What in your personal journey and your evolution led you to get to 10 to 15 as being a number that you feel really comfortable with in terms of the level of concentration?
Sure. In terms of why not higher, I've worked at, I was fortunate that after Harvard Business School, I worked at T. Rowe Price, which was a great firm, and just lots of really thoughtful investors, and investors with different investment styles. And, there, a more concentrated fund might have 100 or 150 positions in it. And then some of the more diversified funds might have 300 names or something like that. So, on the extreme end, I always knew that felt like a little bit of a too high number, for me. And a lot of the time while I was at T. Rowe, I was investing in my personal account and really enjoying that process. And that 10 to 15 number always kind of felt natural. And then since T. Rowe, I've worked at other firms that have maybe owned fewer positions. Maybe it was sometimes 20 to 30 or 60 names in a portfolio or something like that. And those sorts of numbers still felt, a little too big and a little too spread out to me, both in terms of the return impact that an individual name could have, also in terms of just getting spread maybe a little too thin in terms of the maintenance work on those names. So that kind of, those experiences kind of helped me, sort of narrow it down to, a number that's maybe more in the 10 to 15 range. And I don't want to necessarily be too precise there. Maybe there'll be a time where there will be 9 excellent companies in the portfolio or something like that. And in terms of why not something like 5, to me, that maybe feels like a bit too much concentration, and again, just kind of knowing, hey, as much work as I do on any name, and recognizing that over time we'll continue to improve and get better as investors, I still know I'm going to make a lot of mistakes. And so, I want to be concentrated enough where those names have a punchy impact. But I also don't want to be so concentrated that, when one position inevitably goes down 30, 40, 50%, that it has a huge impact on the portfolio, or potentially impacting, my emotions and my ability to kind of focus on optimizing the portfolio for great long-term success.
We talked about sell discipline a little bit, and that's a kind of a topic of your letters as you talk about sell discipline. So let's say we talked about what happens when a business isn't working. Let's flip it and say something is working. So in that situation, how would the quality of business impact if you're willing to sell a stock as it approaches or even exceeds your estimate of intrinsic value?
Great question. So the quality of the business will definitely have an impact. And typically that's something I will think about quite a lot. So I mentioned in my last investor letter where I was talking about the home builder MVR. And, MVR is a company that I fully expect over time to have more market share. But I also know that housing can be a very cyclical industry, and that not all times in the housing industry are rosy, and there are certainly challenges for that industry now and during most times. And so a business that maybe has more cyclicality to it, or for some reason I might feel is on the lower end of the quality side, those are going to be ones that I might think a little bit harder about. What does this position size look like, or how much might we allow that business to compound over time? But in general, to your point, I really do want to just be as patient as possible and own high quality businesses and let them and their management teams just continue to create value for us.
And do you have set position sizes? I mean, 12 to 15 names, we're talking, 6 to 8.5% positions. Like, are there specific ones, like you're going to have a 15, and 10, and a 5? Like, how do you think about those? Like, especially as something that maybe has done well and you're going to trim it, where does that go down to in terms of the lowest position weighting?
Sure. So on the first part of your question, I've generally leaned towards equal weighting positions over time. Now, today, if you look at the portfolio, some of the larger positions are around 10%, and then there are some smaller ones that are maybe around 4% or so. But in my mind, I kind of think of it as, hey, there are a lot of positions in that kind of 5 to 8% range. And again, the ones that, I think have better return potential, they might be, on the bigger side. But also I don't want to be too precise about it either. So that's kind of the way I think about it, especially on the front end. In terms of, it sounded like maybe your question was around trimming, or after a company has done well, where does it go? That's always going to be on a very case by case basis, and what I think about kind of the future return potential for that investment.
Got it. And you mentioned NVR, and when we first chatted, you mentioned how surprised you were that home builders, one of which you owned, which is the NVR, had done so well in the past year. What did that, especially when the housing market looked like it was going to be very troublesome for probably, it could look maybe 18 months or longer. So what did that experience drive home to you about the value of trying to predict what's going to do well in the short run?
Sure. That's a good example, but just one example of a lesson that I feel like I've kind of learned and seen many times in my career. And yeah, I just try not to, have big macro views. I obviously want to be aware of what's going on and how, certain events or certain challenges might impact the companies that I own. But beyond that, I don't want to be, a big macro prognosticator, just because I think it's incredibly hard to make those predictions and make them accurate. And so during parts of last year, NVR had probably gotten down to, I don't know, $3,500 per share, or $4,000 per share. And I remember penciling out that I thought, even in a pretty bad case, maybe not like a great financial crisis type of case, but in a nice slowdown for the housing industry, I thought that the company could probably earn $350 to $400 per share or something like that, for a company that has a lot of advantages and incremental returns on capital, typically above 30%. And so those were some things I thought through that just kind of helped me to kind of think longer term in that situation. And I wouldn't have guessed 12 months ago that NVR might be one of the better performing stocks in the portfolio this year. But that's kind of the way things go sometimes. And if I have a portfolio that has 12 to 15 bets that have different exposures and different things that could help the company over time, then I want to be around and let that serendipity and that value creation take hold.
And we've talked about NVR. You also mentioned OReilly. You have a few case studies in your investment presentation. I'm interested, if I asked you what the quintessential right tail stock would be, what comes to mind? And I'd love a quick overview of how that fits with this quality at a discount strategy.
Sure. In a lot of ways, I don't necessarily want to be tied to any one company, and kind of along the way that I think about concentration and whatnot. But I'd be happy to talk about OReilly a bit, and some of the characteristics that I do think have made it a great investment for right tail over time. The first time I invested was actually early in COVID, and I forget exactly. I want to say the stock had maybe gone from $400 or $450 a share down to $250 or $300 per share. And I had admired the way the company was run, and that they tended to be longer term in nature. For some of the listeners who maybe don't know, OReilly is an auto parts retailer. And one thing that's unique is, from each of their stores, they basically serve two customers. They serve do-it-yourself folks like you and me that might want to make a repair on our cars. And they also serve mechanics. And both of those customers, especially mechanics, they really want to find the right part and to get it as quickly as possible. And there's a whole host of reasons why the mechanics might want that. They want to keep their customers happy. The car insurance companies who might be actually paying for the repair work, they realize they'll be able to keep their customers happy and hopefully keep their customers for longer, if they're able to get that repair done quickly. And so OReilly really invests a lot in their distribution capabilities and their supply chain, to have the best selection of inventory. And they're very specific about what inventory they carry in certain markets based on the cars that consumers own in those markets. And then to just have the right parts and to have knowledgeable professionals working those stores, that can help the customer find the right part. And so what the service they provide is pretty unique. They certainly have a lot of advantages in terms of their systems, their capital, their breadth of inventory relative to mom and pops that over the long term have been a source of supply gains. Though they've also been able to typically grow faster than some of their larger public competitors, like an Advance Auto Parts or something like that. So those are some things that the company does well and how the company is positioned. In terms of the management team, a lot of these folks have been there for 20 years or longer. The new CEO, Brad Beckham, who's coming in, started at O'Reilly shortly after high school and has worked through several different portions of the business over time. And his story is not necessarily unique just in terms of that long-term approach they take to their employees and training and things of that nature. And so, that was 3.5 years ago that I invested for the first time, and the company has continued to perform really well. The whole COVID experience and how difficult supply chains became for a lot of companies probably allowed them to take share even faster. And, maybe with the exception of that initial investment, during a lot of times that I've owned O'Reilly, or a lot of that time period, the stock, I would not say, has necessarily traded at the cheapest multiple. And so, it's one reason why, O'Reilly is a good retail investment to talk about, because, during a lot of that period, maybe the multiple was somewhere between 18 and 22 times earnings, maybe even a bit higher than that. But again, through thinking through some of those opportunities of how the business could grow over time and the benefits that came from opening new stores and opening new distribution centers and things of that nature, have really led to a lot of value creation for shareholders.
If I think about your strategy, the main risk I think you have is that you find businesses with high historical returns on capital, right? And you find them at a decent multiple. The risk is that the incremental returns are not as high as you think, and the market's is telling you something when it's trading at a sub S&P multiple. Anything that you do to try to protect yourself from investing in businesses where the incremental returns are declining or not as high, and probably end up being value traps over time?
You highlight a very real and possible risk, Ben. So for sure, that's something I think about a lot. I don't want to say that there's one thing that that I do that I think avoids that. And over time, I likely will invest in businesses that end up being value traps. But studying the history of those companies, studying what has led to stronger incremental returns. So I'm probably a little less likely to invest in a business where the returns have already been declining quite a bit. So that's one thing that I'll look out for. And then I just try to think through, okay, what's going on in the industry? What advantages has this company built over time? And are those advantages, getting weaker, staying the same, or getting stronger? And then constantly, doing that maintenance work and listening to what the companies are saying, reading their filings, talking to folks in the industry. And ultimately, there's certainly a part of investing, or at least the way I do it, that involves a fair amount of art versus science. And it ultimately, parts of it are going to come down to a bit of a judgment call of hey, what do we think is really going on here?
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders.
And the other risk I would see in your strategy, if I were putting capital to work in it, is the ability for you, a small team, the ability to cover the entire universe of stocks that you could look at. So I'm interested in how you schedule your time and structure your days and your quarters so that you can balance the new idea generation with the maintenance that's required on those 12 to 15 names or 10 to 15 names.
Sure. And you're absolutely right. Both both maintenance work and working on new ideas are incredibly important. I try to structure my days where, I find that I'm more productive in the morning. So I tend to do, kind of more research and kind of deeper reading and thinking a little bit more in the mornings. And then most weeks will likely have both maintenance and work on new names. And I don't have an exact number of new names that I want to work on each week or each month. I would say normally it's probably at least 1 to 3 new names per week. And it can easily be on the lower end if, working on a new name kind of leads to more work, because there seems like there could be some, really interesting investment potential there.
Got it. And what's the sign that something should come, kind of off the bench and or maybe I don't know what the right metaphor is, but something, what gets you interested to say, like, this is something that I've spent X amount of time on, and this makes sense to spend another, 10, 20, 30 hours on? What kind of characteristics are you looking for?
Sure. Well, I'd love to think that, a potential new position would have a higher return potential than, certainly the median name in the portfolio or something like that. So as the return potential appears to be there, either because, maybe the stock price has gone down, or I have a better appreciation for the reinvestment potential of the business, that could be something, I'm kind of thinking, hey, we need to do a lot more work here to, go through any questions I'm worried about, or parts of the business I don't necessarily understand that well. So that would be the most important thing. And then the second thing would be, hey, is there something a little different about, this business or this industry that might be additive to the overall portfolio, or increase the diversification while also having a great amount of upside potential within the confines of a concentrated portfolio.
And you talk about the anticipation that you're going to make mistakes, and that's a reason why you don't own 5 stocks. I'd love an example of a mistake that has meaningfully impacted the way you invest now.
Sure. The first one that comes to mind that has been one of the biggest learnings is, when I joined T. Rowe Price in 2010, there weren't a lot of analysts and portfolio managers who had left T. Rowe coming out of the great financial crisis. I think during that time, a lot of my colleagues appropriately, saw T. Rowe as a great company and, a great place to build a career. And so, when I got there, there were fewer industries left to cover, and I was very open-minded in terms of what I wanted to cover. I was hoping it wouldn't be something incredibly macro sensitive, and lo and behold, it ended up being small cap metals and mining. So not just metals and mining, but also small cap, where a lot of these companies did not even have a mine in operation, and the budget to build one mine was often larger than the current enterprise value of the business. So, it led to these management teams always trying to raise money and to tell an attractive story about, why this company deserved investors' capital. And so I remember, I tried my hardest, and I had a lot of great experiences being able to visit mines in different parts of the world, and met a lot of interesting people along the way. And I would try to invest in some of the higher quality small cap metals and mining companies, but ultimately realized a lot of it was really a macro call. I realized, I wasn't very good at investing in those types of situations, and I was probably, more of a weaker hand at the table. And, I also realized that a lot of times that these projects that companies are investing in typically they're communicating, what I would consider to be like the best case outcome, and maybe not, the base case outcome. And so it was great to have some of those learnings, kind of earlier in my career, and make some of those mistakes. And that's one of the experiences I can think of that just kind of helped me realize that the best way to align my skill set and my temperament to produce great investment results is to focus more on studying higher quality businesses versus businesses that maybe don't have as much control over their own destiny.
Sure, that is such an interesting place to start a career in investing. That's a wonderful story. So, I mean, you mentioned working at T. Rowe, and you've worked at some large firms that have been able to attract institutional investors. Is that something you aspire to incorporate in the future of Right-Tail?
Great question, Ben. I think a lot more about just the overall quality of the investors, and I try to spend a lot of time with investors and early conversations of just trying to make sure that we're all kind of playing for the same thing, which for me is, I want to have, excellent sustainable returns over longer periods of time. And so I really want to find investors who similarly think longer term. And that can be, an investor of, any shape or size. And if it ends up that, over time that Right-Tail finds some institutions that think similarly, that could be amazing. But also, I'm very fortunate to have 40 awesome investors today. And it's been a really interesting mix. Each relationship is really important to me. Roughly 25 to 30% of my investors are other professional investors who, do this on a day-to-day basis. And again, I think, understand what I'm trying to do. And so that's fantastic. Roughly a third of my investors have added to their investment, during the, kind of year and a half or so that Right-Tail has been investing. So that's been fantastic. And so, yeah, each investor is important. And if I continue to do a good job of, putting smiles on people's faces and producing good investment returns, then over time, I think things will kind of work out the way they're supposed to.
So you're about a year and a half in. I'm interested in what you think success would look like if we're having the same conversation 7 years from now. What would be your idea of success in terms of founding and building Right-Tail?
Sure. A lot of it comes down to just producing great returns. I think that will be one thing that will really keep investors happy. I do aspire to have great relationships with each of my investors. So, if I can be helpful in other ways in addition to producing good returns, then I'd love to do that, and I love kind of the relationship. So that's really what it all comes down to. And I recognize that I'll be spending a lot of time with anyone who's connected to Right-Tail. And so I really want to just spend my time with other thoughtful and really kind of deep down good people, and that'll be incredibly fun and satisfying, hopefully for all of us.
And is having a team a goal? I mean, putting together a team of analysts and having the whole, something that looks more like a traditional investment firm versus, kind of like where you are in startup mode.
It's something I think about a lot and have thought about a lot over the years. My best sense is that I think Right-Tail will always be 5 people or less. And we could be talking in 7 years, and it may just be me. And so I think as as the business reaches different stages, I'll always try to approach it, from the perspective of, hey, would it be kind of a win for everyone involved if Right-Tail's team were to expand? First and foremost, would it be a win for our investors? And the two roles that I could see, potentially being most likely, one might be, a junior analyst that I could work with, hopefully mentor and, have an opportunity to, listen to this person's perspective on current investments in the portfolio and to do some of that maintenance work together, potentially also look for new ideas together. I see myself as always being, first and foremost an analyst and very deeply involved in the analytical work. So I'm less interested in someone who, is just kind of sourcing ideas, individually or something like that. So that would be one role. Another role might be someone who could wear several different hats. So maybe a Jack or Jane of all trades who could help with some operations and, maybe signing up new investors and things like that. All of which have been, really fun roles and good learning experience that I've enjoyed so far. And if we do get to that point one day, I'll also appreciate both in terms of being able to work with other potential Right-Tail colleagues, but also in conversations with investors to, be able to, say, hey, I was very involved as we, set up the first 40 investors or whatever the number, ends up being. So it's all been a lot of fun and a good learning experience.
Well, Jeremy, we've covered a lot throughout this podcast. So we're going to close with a question we are asking all of our manager guests, which is, what is the most underappreciated aspect of the investing opportunity set you're pursuing at Right-Tail?
Sure. I think the most underappreciated aspect is just that this philosophy of wanting to own higher quality businesses for the long term is much harder to execute than maybe it sounds when it's kind of put very simply. And I have the wiring and the experience to give Right-Tail the best odds to be able to produce great investment results. And one of the things that I find inspiring in a lot of ways is that I often get asked, well, what's your new, most favorite idea? I've heard you talk about Ferguson before, or whatever the case might be. And a lot of the times, my answer is just, hey, I still own the same companies. There's some new ones that I'm thinking about. But a lot of times it's owning the same ones. And so to me, those questions, and they're very sincere, and I appreciate all of them. But to me, it kind of highlights that, having this longer term perspective is more unique and tougher to execute than I think, maybe it sounds when, it's stated on paper or discussed very simply.
Jeremy, this has been great. Thank you so much for being on Compounders. It's great hearing about the whole journey that you've been on over the last year and a half. And, we're going to be watching your career closely over time. So thanks for thanks for the time.
Thank you very much, Ben. Have really enjoyed it, man. And it's been a fun discussion, and look forward to continuing to be in touch with you.
Wonderful. So you mentioned Visa, MasterCard, and Moody's. Do you own any of those companies?
I do own Moody's today.
You talked about Ferguson. Is that a stock you own as well?
Ferguson is a stock I own as well.
In this podcast, Jeremy discussed a number of securities, including Visa, MasterCard, Moody's, and Ferguson. I do not own any of those stocks. In addition, I also do not own OReilly or NVR.